And we're live. All right. No, well, not really live, but we're going to start the session right now with Facebook. I have, okay, right now, let's put it on 10 years of data, monthly candles. Well, actually, I have data up to May 18th, 2012, 5 years and a half for FB. Let's see what it's at. That's a nice ascending channel for that long period of time. Is it in the channel? It could have been here in an ascending channel, then even broke out of it. Higher channel maybe eventually, but nothing to support that right here. Well, the trend is definitely still bullish. Let's just see if there's some divergence. Hard to tell. It's not a high. Okay, maybe here. Higher highs in RSI. Higher highs in the price action. Nothing to see here. Still bullish. Honestly, this I don't see much right now to enter based on the classical charting principles on the monthly candle chart. No clear patterns giving me a target where I could exit for a profit. And without that, I can't just write this. This kind of reminds me of my beginning of my trading career. Is if I would have played this as a Stan Weinstein. One of the early books I read was a Stan Weinstein Bull and Bear Markets. How to Succeed, I think, in Bull and Bear Markets, the exact title. And what my takeaway from his book was weekly candles, and with weekly candles and the 30-week moving average, when you had a period of, let me zoom that here and back out all the way to the beginning of the data. So when you have a 30-week moving average that's going upwards, right now I'll take away the 10, so you only see the 30. So when you have the 30-week starting going upwards and breaking above a support line, a resistance line, that was called, I think this is a stage 1 consolidation area, the congestions. That's what I like to see and look at also, that sideways action. And after that, what he had is stage 2, which is the bullish move. And then eventually he had a stage 3, which is a topping formation like this. Maybe it was a topping formation here. And and after that, stage 4, which the price action goes down. But he also says that after consolidation in the stage 3, you can also probably, you could go up also. So he also covered that. And you would place your sell stops. You would ride the wave to maximize profits. He didn't have a profit stop. He just had sell stops that he would set under previous lows that were retraced and confirmed as lows. So you would have been in here, back down here, and then when the price reached the previous, I think, high, you move your sell stop from down here to here. Price action goes up, then it goes down, then goes up again. You sell stop, you move it from here to here. So if ever there's a retrace, that would be your stop loss, and that would permit you to continue to stay in a trade, as long as the trend is in your favor. Really, really maximize your profit. Sometimes when classical charting, you reach a target, but the trend could continue in that direction that you chose, but you've exited because you've put your profit stop at the implied measured move. So that's part of the trade-off of classical charting principles versus Stan Weinstein, which was more support and resistance. Still respected that, but more based on the moving average and moving your sell stop on each successful retest of support and going back up to the previous high. And right here, you would have had a stage 3. Your sell stop would have still been here. You'd still have been in the stock. And you would have been, probably you could have continued to ride this all the way to the top. See, sell stop would have moved maybe here, and here, and here. You'd probably still be in Facebook right now if you would have been playing the Stan Weinstein, maybe here. Wow. Impressive stuff. So I not in the stock based on classical charting principles. I could have had an entry here, but I would have probably been triggered out to my target after reaching my implied target, you see. So now I would have been out maybe here, or maybe I would have been triggered out with this candle here. So different way of seeing, of playing. Being able to apply risk and management protocols to chart price action. Very impressive for Facebook for all these years. Now I could take a look just to see on the, go back to the 10-year. Control Z. No. I'm going to undo, remove all trend lines. There seems to be some, hold on, I'm going to first add my little black area, which I like, which permits me to better envision what the possible move could be here or not. So I'm going to send an alert here at this could be support 170. So for the past 1, 2, 3, 4, 5, 6 months, it closed above, monthly candle closed above 170. So this could be some good support here. And resistance, hard to tell, hasn't been really. Maybe this was resistance back then, but there's not a lot of candles. There's less strength to the possible move of a classical chart pattern, the less candles there are in it. The more candles, the more value you have to the implied measure move added to the breakout line if it comes. For Facebook, in this case, I would just maybe put an alert just to jot my memory if it ever gets triggered. So I get an email, and then I would connect and say, oh, it's there. It's morphed. The chart has morphed. More candles have been added. This consolidation, maybe sideways pattern, will be more defined. The range will be better defined, better test of resistance, better test of support. And that's what I would do. Following that, I can't play. There's no entry for me here. If you're already in, well, respect your decisions. That's what I always tell. The best advice I give to people is decide ahead of time your entry and your exit and your exits of any trade. So before you always place a purchase order or a sell order attached with bracket orders, and always identify when you want to go out, the price, and how much pain your money management protocols will permit you. So you always try to keep that in mind. Let's say I would go in here at this price, 185. Let's say my target would be 215, and then I'd say I want to put my sell stop under the bottom of that candle, and that's it. I enter place an order for 186, and I put bracket orders, sell stop at 176, and profit stop at 215, and you forget it. No emotions. You could read the news, but that could be just torture or just fun, considering depending on your personality. And it's lock and loaded. Forget, and you wait till either one of these get triggered, and you do not change your mind. You do not do anything to that. And that's my best advice I could give you for any trade. And for any trade, I recommend not this from the entry to the point that you stop loss out of it. That shouldn't be more than 1% of your total NAV. So if you have 100K in your net asset value, calculate the difference between this and this, the price, times whatever the amount of stocks you have. and that shouldn't be more than 1/100th of your 100K. So that shouldn't lose more than $1,000 here. And on the upside, well, ideally, maybe, well, it depends on the chart, what it implied the measure move, but 3 to 1, the ratio between here and here is great. Even if it's twice as high, the target, you're still good. I could get in more details later on. We could actually punch in numbers in my spreadsheet where I calculate the risk to reward ratios and how much I have to buy a certain stock to respect my max pain of for my stop loss. That should be all fun for now, but I'll try to do it for stock where we're actually going to consider getting into an A++ classical chart pattern. It'll be worth it to do that work and maybe actually pull the trigger and place the orders with you guys. All right, that's it. Thank you very much and see you soon.